Have you ever actually thought about the physical backbone of your digital life?
Most people probably haven't.
Right. I mean, seriously, every single time you stream a movie or, casually scroll through social media or jump on a high definition video call.
Which we all do a dozen times a day.
Exactly. There's a literal piece of steel, concrete, and real estate making that invisible signal happen.
It's all physical at the end of the day.
It really is. So welcome to this deep dive where we are looking directly at that physical backbone. Our mission today is to unpack the financial and strategic health of the digital infrastructure world.
Because it tells us exactly where the entire tech sector is heading next.
Yeah. And to do that, we are going straight to the source. We have a massive stack of documents from SBA Communications. They're one of the largest cell tower real estate investment trusts, or REITs, on the planet.
Massive global footprint.
Huge. We are dissecting their Q4 2025 earnings press release, their investor slide deck, and the full unedited transcript of their February 26, 2026 earnings call.
Which is such a rich source of intelligence. If you're listening and wondering why you should dedicate your time to a cell tower company's earnings report.
It sounds a bit dry on the surface.
Right, but it's really not. These are not just dry financial numbers. These reports serve as the ultimate leading indicators for the entire global economy.
Oh, absolutely.
They show us exactly where human behavior, artificial intelligence, and global telecommunications are shifting. Long before a new tech trend ever reaches the device in your pocket, it has to show up on a balance sheet.
As poured concrete.
Poured concrete, secure land leases, and upgraded steel antennas.
Okay, let's unpack this starting right at the top line with the Q4 results. We've got the money, the slight miss, and honestly, an incredibly spicy serving of corporate drama.
The drama is always the best part.
It really is. So, looking at the financial snapshot for the fourth quarter of 2025, SBA actually beat the street's consensus on earnings per share.
Right.
They hit $3.47 actual versus the $3.25 expected. But they did narrowly miss their revenue targets.
Just narrowly.
Yeah. They pulled in $719.58 million actual versus an expected $725.80 million. Though I think it's worth noting that total revenue is still up 3.7% year over year.
And, the market's reaction to a slight revenue miss can sometimes be turbulent.
Oh, definitely.
But management signaled immense confidence through a very specific mechanism here, which is their capital return strategy. They didn't just maintain their dividend.
They bumped it up.
They raised it by 13% to $1.25 per share. And on top of that, they really stepped on the gas with their share repurchases.
Those buyback numbers were huge.
Yeah, they spent $213 million in the fourth quarter alone to retire 1.1 million shares.
Wow.
And when you zoom out to the entirety of 2025, they deployed $500 million buying back 2.5 million shares.
That is a massive flex.
It is. That level of capital return tells you management believes their core cash flow is incredibly durable, regardless of a slight quarterly revenue flutter.
That durability is put to the test, though, when we talk about the elephant in the room.
Here comes the drama.
Yeah, that revenue miss didn't happen in a vacuum. Looking through the call transcript, their bad debt expenses completely blew past forecasts.
Yes, they did.
The culprit, EchoStar, which most of us still know as Dish, they basically just stopped paying their rent on the towers.
And the fallout from that was swift, and it was severe. SBA did not treat this as a simple late payment.
Not at all.
Based on the earnings call, they terminated the contract, they accelerated the rents that were due, and they filed a lawsuit against EchoStar.
They did not mess around.
No. And to give investors the absolute cleanest possible view of the business moving forward, SBA's management entirely stripped all of EchoStar's recurring revenue out of their 2026 guidance.
They just zeroed it out.
Completely zeroed it out.
Yeah.
They're running their projections as if that money simply does not exist. They're entirely separating their financial outlook from whatever happens in the courtroom.
I have to highlight the Q&A portion of the earnings call on this specific topic because it was incredible.
Oh, the New Street Research question.
Yes. David Barden came right out and asked what everyone was secretly thinking. He essentially said, look, if Dish isn't paying their bills, why doesn't SBA just send some guys out to the sites with a pair of heavy-duty snippers, tear down the Dish equipment, and sell it for scrap metal?
I mean, you really have to appreciate the sheer bluntness of a Wall Street analyst casually suggesting a corporate repo job on live telecom equipment.
I was literally laughing out loud reading the transcript.
It was definitely a colorful moment, to put it mildly, but the CEO's response was incredibly cool and collected.
What did he say?
He just flatly replied, "We follow the law."
Yeah.
What's fascinating here is how tower companies actually wield their leverage when a major telecom carrier defaults.
They don't need guys with wire snippers.
Exactly. They absolutely do not need guys with wire snippers because they hold the ultimate infrastructural high ground. The highly expensive equipment on those towers is utterly useless without the real estate it sits on.
Right, it's just metal in the sky.
By accelerating the rent, they are legally demanding the entire remaining value of the contract immediately. It's a scorched earth legal tactic.
Wow.
They rely on the legal system to enforce their contracts, which ultimately protects the predictability of their entire business model. They are a real estate trust first and foremost. Their strongest weapon is a lease agreement, not a pair of pliers.
That makes perfect sense. Keeping with the theme of navigating these massive telecom transitions, let's look at the U.S. market as a whole.
Okay.
SBA is still dealing with a bit of a consolidation hangover from the Sprint and T-Mobile merger. The 2026 outlook bakes in about $55 to $56 million of Sprint-related churn as redundant towers are decommissioned.
That's a big chunk of change.
It is, but there is a very clear light at the end of the tunnel here. Management explicitly noted that this churn drops significantly, plunging to under $20 million by 2027.
Which signals that we are finally reaching the end of a very messy, multi-year era of carrier consolidation.
Thank goodness.
We are moving into a stabilized, definitive, three-carrier market in the U.S. with AT&T, Verizon, and T-Mobile.
The big three.
And for those three carriers, maintaining a high-quality end-user experience is the only way to prevent their customers from jumping ship. You can't compete on network quality without massive, ongoing investment in the physical network itself.
And the demand driving that investment is just staggering. I saw this stat in the sources and it genuinely blew my mind.
The data consumption one.
Yeah. According to the CTIA data cited on the call, Americans consumed more than 132 trillion megabytes of mobile data in 2024.
It's hard to even conceptualize a number that big.
132 trillion. That is a 35% jump from the prior year. It is the single largest jump in the history of the tracking data.
Think about the pure logistics of that. A massive driver of that consumption is the absolute boom in fixed wireless access, or FWA.
Which is basically home internet, right?
Exactly. This is where people get their home internet beamed in over the 5G network instead of using a traditional fiber or coax cable. The CEO noted that FWA has hit roughly 15 million subscribers.
That grew so fast.
It did. It is so wildly popular that it is now eating up over half of the overall wireless network capacity in the U.S.
Over half.
Over half.
That is wild. Surfing the web on your phone is one thing, but running a household's worth of 4K smart TVs, gaming consoles, and work-from-home setups over a wireless signal that has to put immense strain on the local tower.
Oh, without a doubt.
To support that, SBA is expecting $35 million in incremental U.S. leasing revenue in 2026. And a good chunk of that seems to be bolstered by a newly signed master lease agreement, or MLA, with Verizon.
The new Verizon agreement is the critical piece of the puzzle here. A master lease agreement isn't just a handshake, it's a holistic, long-term pricing structure.
It sets the rules of the game.
Exactly. It gives SBA predictable minimum financial commitments while giving Verizon the streamlined permission they need to upgrade thousands of sites without negotiating lease terms one by one.
Which saves a ton of time.
Verizon, like the other carriers, has to densify its network to keep up with that data flood. And that means bolting heavier, more sophisticated equipment onto existing towers or expanding onto entirely new sites.
So what does this all mean? How do simple steel towers and concrete pads actually keep up with this invisible, ever-growing flood of data?
Well, it requires a fundamental shift in network architecture. And this is where we have to talk about the impending transition from 5G to 6G.
Let's get into it.
Right now, under the 5G standard, network traffic is highly asymmetrical. It is an 80-20 mix of downlink to uplink.
Meaning downloading versus uploading.
Precisely. Basically, users consume far more data streaming videos, downloading large files, than they send out into the network.
Right, nobody's uploading 4K movies constantly.
Exactly. But 6G is going to shatter that paradigm entirely.
Because 6G is going to be intrinsically driven by artificial intelligence.
Exactly the point the CEO is making. With continuous real-time AI interactions, your device won't just be a passive receiver of data anymore.
It's going to be talking back.
Constantly. It will be sending massive amounts of localized data back up to the network to be processed by an AI model. You ask a complex question, The AI needs to process your location, your context, and your audio in real time.
So the upload demands skyrocket.
The traffic mix becomes much more balanced, demanding a colossal increase in uplink capacity.
Here's where it gets really interesting. You can't just fix that uplink bottleneck with a software patch.
No, you can't.
True 6J cannot be done with clever code. It requires massive physical changes to the infrastructure.
It requires a total rethinking of where computing physically happens. Historically, the brain of the internet lived in massive, centralized core data centers. Think giant warehouses in Virginia or Oregon.
Right, in the middle of nowhere.
But to achieve the ultra-low latency required for real-time AI, so your device can interact instantly without any perceptible lag that computation has to move closer to the user. It is moving from the core out to the RAN.
The radio access network.
Yes.
Which in practical terms means the cell tower itself.
Precisely. Towers will need heavy physical compute capabilities right at the site. We're talking about high-density, liquid-cooled server racks sitting on a concrete pad next to the monopole.
That's incredible.
They are essentially becoming intelligent mini data centers at the extreme edge of the network. And during the Q&A, an analyst actually asked if SBA was going to start buying big standalone data centers to capitalize on this AI boom.
Oh, that's a fair question. What did they say?
The CEO gave a definitive no. They learned from some early investments that competing with Amazon Web Services or Microsoft in the hyperscale data center market is a losing battle.
Yeah, that's a tough crowd to beat.
Instead, their pivot is entirely toward edge computing. They plan to utilize their incredibly distributed portfolio of sites to lease the space and power for compute right at the base of the towers.
They want to be the landlord for the edge.
Exactly. Landlords for the edge.
That is a massive paradigm shift in how we think about a cell tower. But while we're talking about the future of the network, another analyst brought up a completely different kind of tech.
The satellite question.
Yes, direct-to-device satellite networks. We see all these headlines about new phones connecting directly to satellites in low Earth orbit. Is that space race a threat to terrestrial cell towers?
The CEO's answer was an emphatic no. He views satellite technology as strictly complementary.
Complementary, not competitive.
Right. Satellites are fantastic for fixing rural white spaces.
Yeah.
Those deeply isolated places where it just isn't economically viable to pour concrete and build a tower for 3 users.
Like out in the middle of the desert.
Exactly. But when you factor in the heavy latency of bouncing a signal to space and back, coupled with the massive uplink demands of 6G and AI that we just discussed,
The satellites just can't keep up.
they simply cannot physically handle the bandwidth. The terrestrial network, the towers bolted to the ground, remain the indispensable backbone for the heavy lifting.
Okay, let's zoom out and look beyond the U.S. now, because SBA is a massive global player. Let's talk about their international adventures, starting with their second largest market.
Brazil.
Brazil. They have over 12,000 sites down there. And there was a highly memorable comparison in the sources regarding network density.
I remember this.
Right now, Brazil only has about 4 tower sites per 10,000 people. Compare that to the U.S., which has roughly 16 sites per 10,000 people.
That density deficit represents a massive multi-decade runway for organic growth. Right now, Brazil is just finishing up its own messy era of telecom consolidation.
Very similar to what the U.S. went through with Sprint.
Exactly. The transcript notes that SBA has a $14 million headwind pulling into 2026 from the Oi wireline consolidation.
And Oi was one of Brazil's legacy telecom players, right?
Yes, they went through a massive restructuring. But once that churn is in the rearview mirror, you combine that gaping density gap with the upcoming 450 megahertz and 700 megahertz spectrum auctions by the Brazilian government.
The perfect recipe for growth.
It is. Carriers are going to be forced to collocate new equipment on SBA's existing towers to put that newly acquired spectrum to work.
But operating internationally isn't just about building towers and waiting for carriers to show up.
Definitely not.
It's about navigating complex global economics. There was a fascinating macroeconomic debate during the Q&A regarding the Brazilian currency, the real.
The currency chess game.
For their 2026 financial guidance, SBA assumed an exchange rate of 5.20 reais to the dollar. But an analyst pointed out that some of SBA's competitors are assuming a weaker 5.50 rate.
And the actual spot rate on the day of the call was 5.14.
Right.
If we connect this to the bigger picture, you see exactly how the CFO, Mark Montagner, defends their strategic position. This isn't just accounting trivia. Foreign revenue translates back to U.S. dollars to pay that dividend we talked about earlier.
Right. Wall Street wants dollars.
Exactly. He didn't just pick a number out of a hat. He pointed to Brazil's strong short-term interest rates, which are sitting around 15%.
Wow, 15%.
That attracts a lot of foreign capital. Furthermore, he highlighted that Brazil is a massive net exporter. They exported over $4 billion more than they imported just in the month of January alone.
That's massive.
When a country exports that much, global buyers are forced to purchase their currency, which structurally strengthens it. It really highlights how running a global infrastructure REIT is as much about macroeconomic forecasting and currency chess as it is about pouring concrete.
It really is. A tower in Sao Paulo pays rent in reais, but Wall Street demands its dividends in dollars.
Precisely.
And just to touch on one more international move, they've been busy integrating their recent Millicom acquisition in Central America.
Oh, that was a brilliant play.
They made an incredibly savvy real estate move alongside that tower purchase. They bought the actual land underneath 3,900 of those sites in Guatemala. They paid $109 million for the BERT, and the CEO noted it was done at a highly accretive mid-single-digit multiple.
Which is a classic, brilliant REIT maneuver.
Break that down for us.
Let's unpack what an accretive mid-single-digit multiple actually means. It means the purchase price was so low relative to the rent they were previously paying to third-party landlords that the investment pays for itself very quickly.
So it's an immediate financial win.
It immediately boosts their overall earnings per share. But, more importantly, it eliminates the biggest existential risk to a tower company.
Which is?
A landowner refusing to renew a ground lease.
Oh, right, because if you lose the dirt, you lose the tower.
When you own the dirt, you permanently secure the asset. You don't have to worry about lease renewals on the ground when you hold the deed. You completely de-risk the portfolio while simultaneously boosting your financial return.
Okay, we've covered a staggering amount of ground today. To summarize, we are watching the definitive end of a messy but necessary era of telecom consolidation in the U.S.
We finally are.
At the same time, mobile data usage is absolutely skyrocketing to historic highs, driven by the appetite for fixed wireless access. And as we look toward the horizon, the impending 6G and AI revolution is going to transform simple steel towers into intelligent edge computing hubs.
It is a massive structural shift. And for you listening, it's a powerful reminder of the physical reality of our digital world. Every single time you pull out your phone, send a secure message, or ask an AI model a complex question, you are instantly interacting with this incredibly complex web of global real estate, high-level finance, and cutting-edge hardware.
It really changes how you look at the world around you.
This raises an important question, though. As 6G demands that intensive AI computation happens at the physical edge of the network, literally right at the base of the cell tower, to defeat latency, who holds the real power in the future of the internet?
Oh, that is the million-dollar question.
Is it the massive tech giants in Silicon Valley writing the software algorithms? Or is it the legacy real estate companies who hold the deeds to the tiny, irreplaceable patches of dirt where that software actually has to live to function? Something for you to think about next time you see a cell tower looming on the side of the highway.